Hello students. Yes, so in my previous video I had explained on the internal factors that which affects or influences the capital structure decision. Now we shall understand the various external factors, the how the outside factors are going to impact on the capital structure of the organization. So the first step what you have is the size of the company. What does size of the company talk about? See, size talks about the capital of the organization, whereas a nature speaks about the type of the company or the organization or the sector, isn't it? See, if the size of the company is small, then obviously the requirement of finance is also small. If the size of the business is big, obviously the requirement of the finance is very big, isn't it? So if the size of the business, it is a large, it requires the amount of capital what is required there, it is of course it is a large. So if the plan to raise the small amount of capital, it is going to select only few securities in the capital structure, whereas if the organization, in case if it feels like it needs more capital, a number of different securities will be selected in order to raise the funds with more of the higher level degree of the flexibility in the capital structure. So always whenever you're coming up with the capital structure, make sure you determine the size of the company. Well, it's a big company, big in the sense what's the capital, right? What's the plan to raise the amount of capital? Is it small in nature, like is it big, right? All these are going to matter a lot as an external factor, because for externally you are going to get it all the sources, right? Then where it can be equity, where you can raise it, where it's come to the loans, debentures, right? Again, this particular size of the company, it also matters. Next up is nature of the company or nature of the industry. What does this particular factor talk about? See, a public utility concern, like which has a support and identity from the state and central government, it can raise the funds, like through preference shares and debentures. A capital intensive industry, engaged in a kind of the manufacturing, steel production, it may have a high equity, less and debt capital, right? A trading company, which has less asset structure, it has to depend upon mainly on the equity to meet their particular capital requirements. Like this, the capital structure, it all depends upon what is the nature, what is the type of the industry I am dealing with. This obviously it is going to matter a lot. The next step what you have is the investors. Now what does investors talk about? See, uh, it is that the past behavior of the investors have been changed, isn't it? See, the investors are very very cautious with the investment. They always study it, they are going to see it, because you have political factors, you have social factors, economic factors. There's a factor of inflation, deflation, where there's a movement of the prices, isn't it? So the factors of country has made the investors very alert while choosing their portfolio management. So investors, now what they are going to do, they are going to study, they are going to analyze, if I go ahead with this particular portfolio, what is the risk I have to bear? If I take so much of risk, what is the return I am going to get on that particular investment? So the investors, they have become more cautious. And who are these investors? Investors are the general public, isn't it? The other corporations or the financial institutions, right? So investors is where they are outsiders, right? They are going to invest in your organization, so they have become more cautious with respect to the political, the social and economic factors as well. So next up you have a cost of flotation. What is cost of flotation is about? See, it is nothing but expenses of a firm, which is incurred during the process of public issues, like you're going for the advertising, any kind of campaigning happening on your organization, that is, and printing of application forms, any kind of fees of merchant brokers, underwriting commissions, especially, yeah, that is to subscribe the shares, a brokerage, isn't it? So this speaks about the cost of flotation with respect to the debt. It is always comparatively less when compared to the cost of flotation of the equity. So the financial manager is to see that, like you should try to reduce their cost by having a proper financing mix, that is of debt and equity in the capital structure. That plays a very very vital role. Next up, what you have is the legal requirements. Now, what does legal requirements talk about? See, the legal and the statutory requirements of the government will definitely influence the capital structure. Right? See, the SEBI, that is Securities Exchange Board of India, these guidelines on investors, the protection, maintaining the debt equity ratio and the current ratio as well. It will have, a direct bearing on capital structure, besides all these, like monetary policies, policies, the fiscal policies of the government, it is going to again affect the capital structure as well, right? So the next step is a period of a finance. Say period of finance is where it includes a short term funds, a medium term funds, you have a long term funds, where what happens, see, funds are required, right? See, we have learnt it under the financial planning how it is going to work. Now with the period of finance, funds are required for different period, for different purpose, right? The short term is where it goes for, between 1 to 3 years, where the funds are required, to meet the working capital requirements, where the funds which you require in order to run your day to day operations. It can be raised through commercial banks like a cash credit overdraft. Medium term finances, where which happens between 8 to 10 years, why it is required to expand to diversify your business, right? So you are going to make a proper plan with respect to the period of the finance. The next step is level of interest rate. What does it talk about? See, the rate of interest, it is going to have a direct impact on the borrower's funds, isn't it? See, if the expectation of the banker, that is basically the financial institution, it is more to get the high percentage of interest. A firm, it can postpone the mobilization of funds or can make, the use of retained earnings. Of course, it is going to affect the capital structure. Next up, you have something called as level of business activity. Now, what does a level of business activity talks about? See, it talks about how you are going to deal, how the level of your business activity is been there. Is it into manufacturing, is it into service sector, how the things are going to work, what is the level in terms of taking the risk, what is the level of infusing the money, what is the level of debt you have infused in your capital structure. That talks about the level of business activity. Then you have availability of funds. See, the availability of the money, in the capital and money market, it is going to again directly influence the company's financial structure. Free flow of money in the economy, it is going to encourage a corporate, in order to raise the funds, that is through securities, without like many difficulties. Like, finance manager, what he has to do it here, he has to carefully study the flows, that is that which are available of funds, before he's going to make any kind of decision about the capital structure. Again, the availability of the funds, it is going to matter. Next up, what you have is the taxation, the policy. What does a taxation policy talk about? See, high corporate tax, then high tax on dividends, right? And capital gains directly influence the decision of capital structure. So always a high tax, it discourages the issues of equity, and it is going to encourage issuing of more debt instrument, as the fixed charges on these securities. So interest are something they can be directly it charge the profit and loss account for the income tax calculations. And again, this is one of the factors which influences or affects the capital structure of the company. Then you have the level of a stock a price. So if the general price levels of stocks or the raw materials are constant, over a period of time, then the management, it is going to prefer to invest such funds either through the equity, preference capital, that is in terms of long term or medium term financing. And if the prices fluctuates like too widely, then short term source is the best alternative for such investments, right? Then the condition of the capital market, yes, as I said, it is a very important that at the time of raising the funds, the financial manager has to take care of all these aspects with respect to the availability of money in the capital market as well as in the money market, because they're going to influence the company's financial structure. Because here the free flow of money in the economy, it is going to encourage corporate to raise funds through the securities without any kind of such difficulties. That's the reason it is important to determine the condition of the capital market. Well, these are the external factors that which affects the capital structure of the organization.